You are listening to CMQ Investing. My name is Chris Franco, and I want to talk about dividend investing. This is something that as I've been building out our YouTube channel and just becoming more aware of all the different, I guess call them finfluencers on YouTube, it seems like there's an easy way to win eyeballs by talking about dividend stocks. I'll explain why I think this is in a second, but really what I want to do in this episode or this video is share why companies that pay dividends, sometimes that's not always a good thing. And in fact, I'd argue that for an investor who's, let's say, a millennial or younger, it really isn't that advantageous to receive passive income through dividends that a company might pay out every quarter. And that doesn't mean that you shouldn't, buy a company or buy a piece of a business that pays out a dividend. I mean, even Apple pays a small dividend. But this idea that you go and find companies with, at least 3% or more of a dividend yield and try to build passive income this way, well, there's some downsides to that and some dangers to that are not really discussed on any of these channels that I've been watching or trying to, soak up. So I want to share that with you and just give you that perspective because I do think people are making a mistake by investing this way if they don't have this information. So first and foremost, if you're watching this, you probably know what a dividend is, right? It is a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserves. So the problem I have with dividends, it's not really my problem. It's something that the greatest investors of all time figured out probably before I was born. The best example comes from Phil Fisher. But first, before I get into Phil Fisher, let me just tell you why I think dividends are dumb. So if you need to make extra money and you want to do it passively, I totally understand it. But if you have the temperament to be a long-term shareholder and you're interested in creating long-term wealth, then companies that pay out a lot of money in dividends every quarter, you don't necessarily want to own those businesses, or at least you shouldn't own it because of that dividend payout. When a company has money to pay dividends, it's a trade-off. They could do other things with this money, right? So a business's free cash flow can be used to benefit shareholders, and specifically benefit shareholders through paying down debt, acquiring other companies, repurchasing shares, or in this case, paying dividends. Now, a company that pays out a large dividend or has a large dividend yield, that company is saying something. There's a message there. It says that we don't have a better way to put this money to use. We cannot reinvest this money and make more money at the same rate of return. And so therefore, we are going to give you the money so that you can do what you want with it. Maybe you can invest it another way and get a better rate of return with that money. That's what they're trying to say. Now, it's not always in every case. Let's just be clear. But if a company's paying out, a 6% dividend every quarter, it's telling you something. Now compare this to Berkshire Hathaway. Berkshire Hathaway has plenty of cash. They have the ability to do dividends over and over and over again, but they choose not to. Warren Buffett has, as long as he's been running Berkshire, he's chosen to retain the earnings because that allows the value of the asset to increase or grow. And as shareholders, that's how we profit long term. That's how we benefit long term. That snowball gets to keep rolling down the hill and get bigger and bigger and bigger. When you're paying out a dividend, or when the company pays out a dividend, it's a form of interrupting the compounding process because instead of putting that money back into the wealth compounding machine, they're paying it out to you. Now, the other disadvantage with dividends that never gets talked about is the fact that they're taxed, pretty aggressively. Dividends don't just mean free money. You have to pay taxes on it like it's income that you earned. And that's not always as advantageous as it sounds when you do the math when you buy the shares and you say, okay, if this pays out 5%, I'm going to get this, and I'm on my path to financial freedom. I totally get it, by the way, but that psychology, that intuition there is wrong. And that's what I've said before. A lot of the wisest decisions that we can make as investors are counterintuitive. Let me read you from this book. It's called The Money Masters. One of Phil Fisher's most interesting points is that a conventional piece of Wall Street wisdom on this subject, that reinvesting profits for growth favors larger investors with higher tax brackets at the expense of smaller ones who need the income, is mistaken. Whether a given investor needs a higher dividend depends on what stage he is in managing his affairs. If the investor habitually puts aside some of his earnings each year in the form of savings, it is more efficient for him to have the company plow back its cash to build the business and the value of the investor's share in it, rather than pay out the same money as a taxable dividend. And on the contrary, a high bracket investor who happens to be in need of funds, a contingency not entirely unknown to those in high tax brackets, may have to take money out of the business and thus need the higher dividend. So says Fisher, a company can best serve its investors by following a consistent, predictable dividend policy. In fact, it is management's primary obligation to do so. He himself will be looking for long-term growth, which implies lots of reinvestment of profits at a high rate of return to build the business, and consequently, a low dividend. Another investor may prefer to have a high dividend, which should, in any event, be the policy followed by a company without attractive opportunities to reinvest its profits internally. It is indeed a gross abuse of management's role to reinvest shareholders' money at a lower return than they could get for themselves. Fisher produces an admirable analogy to illustrate his thesis about the need for consistency in dividend policy. Suppose you started a restaurant. A good operator can hope to build up a steady clientele with any of a number of different approaches: low prices and good value, expensive luxury, Chinese or Italian cuisine. There are customers for any of these at a fair price. The word will spread and a following will develop. What couldn't possibly work would be a policy that shifted unpredictably. High quality and prices one day, cafeteria style the next, and so on. People wouldn't know what they could expect and would stay away. The same holds for dividend policy. In passing, Fisher refutes a pervasive Wall Street myth about dividends, that a high dividend can improve one's safety by providing a cushion for the stock and bear markets. Not so, says Fisher. Quote, every study seen on this subject indicates that far more of those stocks giving a bad performance price-wise have come from the high dividend paying rather than the low dividend paying group. An otherwise good management that increases dividends and thereby sacrifices worthwhile opportunities for reinvesting increased earnings in the business is like the manager of a farm who rushes his magnificent livestock to market the minute he can sell them, rather than raising them to the point where he can get the maximum price above his costs. That's a really important point right there. I'm going to say it one more time. An otherwise good management that increases dividends and thereby sacrifices worthwhile opportunities for reinvesting increased earnings in the business is like the manager of a farm who rushes his magnificent livestock to market the minute he can sell them, rather than raising them to the point where he can get the maximum price above his cost. He has produced a little more cash right now, but at a frightful cost. And that's what a lot of times people are doing, taking this passive approach, especially if you're young. You want to be able to find a business that you can, believe in and roll with for 20, 30 years. I mean, that's not easy, but that's how you build real wealth. This idea of, trying to pick equities based on the dividend payout and trying to get the maximum, dividend income every quarter, you're getting something in the short term that's going to negatively impact how you do in the long term. And again, it's counterintuitive. All this follows from Fisher's basic belief that the attractive holding grows and grows and grows, almost always from advantageously reinvested profits. So high dividends mean lower reinvestment, which usually precludes the long-term building of value that investment is all about. So investment is about the long-term building of value. That's what investment is all about. You want to find a business that can grow and grow and grow and grow. But not to get too far off track here, what I'm trying to get at, guys, is just, there's a lot of shallow surface level investment wisdom on YouTube, and I'm not knocking anybody's channel and not knocking anyone's approach, but this is an angle on this subject that I've never heard anyone really talk about. I understand why it's so appealing to, own things that just give you money every quarter, right? That seems very attractive, and especially when you're young, right? But think of it like an analogy I'll use is sort of a record industry one where, an artist will take an advance but forego having, ownership to their masters or, a certain royalty agreement that would give them that mailbox money for the rest of their lives. So dividends, if you can have a company that can reinvest their earnings and do so fruitfully, that's going to wind up a lot better for you as a long-term shareholder than if you take this approach where, you're picking stocks, not just because of dividend, but you're looking for stocks that only have a very, a high dividend yield so that it can spit out cash to you every quarter. And you can kind of reach this point where you say, hey, my stocks are paying me what I need to live every year. It sounds great, but there's some severe disadvantages of that, and it can be very short-sighted. So yeah, again, dividends are great, but if a company can do something more advantageous with the money, and get a better rate of return, then it's in your interest that they retain those earnings and they don't pay out a dividend. So something to consider. I think there's other ways you can make passive income if that's what you're focused on. I think if you're interested in creating long-term wealth, I think that's something that kind of unites all of us. Regardless of where you are now, I think wealth is relative, right? But all of us want to do as best as we possibly can do with the money that we've invested thus far and that we continue to invest. So while dividends on the surface level seem great, you're giving up something in the long term to get something in the short term. So if you can delay gratification, and if you can find businesses that have excellent prospects where, management knows what they're doing with their free cash flow and they can reinvest it, then you want them to reinvest it. You don't want that dividend. You'd rather they retain the earnings. You'd rather they do something, that continues to add value to your asset. It allows them to keep that compounding process going. That's where real wealth is created. So I think it's really interesting to consider this. Let me know what your thoughts are. I'd love to hear, if you have a different take or a different perspective. This is just something I wish someone had, maybe informed me of. Because when I was younger, in my 20s, when I was in my 20s, I thought that, the idea of dividend paying stocks was just, the end all be all. And it's really not. There's a lot more value to be gained with a different approach. So love to hear your thoughts. Thanks so much for watching. Thank you for listening. If you're listening to the podcast on Apple Podcasts or Spotify, for CMQ Investing, my name is Chris Franco. We'll talk soon.